All right, good evening once again. Good evening and welcome to day 2 of our online Forex basic course, June edition. Okay, so yesterday we looked at a lot of things, and today we'll continue from where we stopped. So yesterday we listed our course outline and we started with history of Forex. We went about to talk about broker, who a broker is. We also look at currencies, currency pairs, major currencies, minor currency, exotic currency, and all of that. So something that we were supposed to look at yesterday alongside the currency, which was not touched, is trading instruments. Okay, so currency is actually part of trading instruments, which is the number one. But there are other trading instruments that we need to know so that when you start your Forex journey, you will know that it's not just currencies that is traded in the Forex platform. There are other instruments that are also traded with that your MT5 and under the same broker. Okay, so let's look at what instruments are. So trading instruments are the different type of assets or contract that can be bought, sold, or traded in the financial market. Look at the language: can be bought, sold, or traded in the financial markets. They represent various ways traders and investors can participate in the market to try to make profit or hedge risk. So these are some of the trading instruments. So let's look at the first one is stocks. Stocks, that's equity. So for those of us who know what stock is, like Nigeria Stock Exchange, which is back home here, we have different stocks like the Dangote Sugar, MTN, Fitsin, list them. We have a lot of them that you know for those persons who are already in that space, who play in that area. So that is one thing that is actually traded in the market. Okay, then we have bonds. Okay, so bonds are debt security issued by corporation or government to raise capital. All right, so bonds are also traded. Then we have the foreign exchange, which is what we dwelled on yesterday, looking at the currencies and currency pairs. So that is foreign exchange, which is Forex, primarily is the oldest of the market. Then we have commodities. Okay, we have commodities. So commodities are actually physical goods, all right? But what is traded in the platform is the contracts. Okay, so now in this case, you are not buying the physical or selling the physical good, but you are selling or buying the contract difference. Okay, so we have physical goods like the gold, oil, silver, and agricultural products. Those ones are called commodities, all right? Although gold is actually separated from it, and they are called precious metals. So gold and silver, in some cases, some system will separate them and call them precious metals, but they are also commodities. So we also have derivatives, which is contracts that derive value for the underlying asset, like future options, CFDs, which is contract for difference. Now, ETF, exchange traded funds, because the funds that track the index, commodity, or sector and traded like a stock. Then cryptocurrency, which is the youngest, all right? Cryptocurrency are digital currencies like the Bitcoin, Ethereum, Tron, BNB, name them. Okay, those are also traded in the Forex platform. Okay, then we have indices. Now, indices is a measure of performance of group of assets like the S&P 500, Dow Jones Industrial Average. So these are actually company performance, all right, grouped in all of these names, and you can actually trade them in the market. We call them indices. So all of these things listed are called trading they are instruments. Okay, they are trading instruments. So we continue on trading instruments. Now, another very interesting one, which is what I love so much, and this is what I trade presently. Basically, I trade other assets, but synthetic is my primary area when it comes to trading. So I trade synthetic more than every other thing. So for those who are in my community, you know that what we do primarily is synthetics. Okay. So what are synthetics? What are synthetics? So synthetic indices, also called the synthetic market, or simulated market, sorry, or simulated market. Why is this thing showing here? Leave this place. Okay, all simulated markets are computer generated financial markets that stimulate real world market behavior. All right, so now when you hear the word generated financial market, that is a simulated market, so it's not real. All right, they are simulated, okay, and they mimic other assets. So now they often use for trading on platform like Deriv, World Trade, or similar broker. Here there's a breakdown of what they are. Okay, so now the non-synthetic brokers today are just Deriv and World Trade. Previously, it used to be only Deriv. Okay, although there are one or two that have sprang up in the past, but they didn't live to expectation. So they didn't even last 1 year, and we didn't see them again. All right, but World Trade came in 2023. World Trade has been there as a broker for 20 something years, but they introduced synthetic in 2023, late 2023, and in 2024 they came into Africa. Okay, they came into Africa, and since then, we've been driving World Trade as a synthetic broker. So let's look at the key features. Now, simulated by algorithm. All right, so there is a system that is programmed, okay, that generates the prices. All right, okay, so prices are generated by random number generators, which is the RNGs, often with verified fairness, okay, with verified fairness. Now, this is a structured market, okay? Now, in as much as they are not real markets, but it's a structured market such that the same way the market behaves, the chart behave on Euro USD and the REX that you know, that is how this chart too behaves. All right, the movement, the what you know in terms of technical structure and all of that is the same thing. But the only thing that is there is that they are not like the real markets, that when you see Euro USD with broker A, the same thing you see it with broker B, broker C, and all of that. Now, another thing about synthetics is that they are proprietary. All right. What I mean by proprietary is that they are owned by the broker. So what Deriv have is proprietary to Deriv. And what World Trade has is proprietary to World Trade. So it's World Trade that has that asset, no other person have it. The name is unique and the behavior is unique. Okay? So now these guys are available 24/7. That's why I love it. Even on Christmas Day, we make money. All right. I know I traded on Christmas Day, this last Christmas, and even the previous Christmas, I still made money. So that is one beautiful thing. There is no holiday. It's 24/7. 24/7, no holiday, no weekends. Anytime you wake up, the chart is available. But the real forex market run from Mondays to Friday, and the market shuts down over the weekend to resume on Sunday night again, and we start a new week. But here, there's no holiday, there's no bank holiday, there's no weekends, there is no, anytime you wake up is your good morning, and you have something to take from the markets. So unlike real markets, they are open all the time with no holidays or weekend. different volatility types. So now, when we say different volatility types, they have different behavior. Now, this volatility, it means their movement, how fast they move, all right? So some move faster than others, some are slow, some are fast, some are just, based on what. So you need to study them to know how each of the asset behaves. So that's why we say different volatility type. Then common types are the volatility 100, 100, 10, 25, 50, 75, the boom and crash, which almost everybody is very used to. Okay, that's in the case of derivative. But in the case of well trade, we have the FX vol 20, FX vol 40, 60, 80, 99. All right, we have XFX of the same range. We have flips, and we also have pain and gain, which is the boom and crash in the case of deriv. All right, so no real world asset behind them. Okay, so you are not trading stock, forex, or commodity. You are trading purely artificial price movement. So that is synthetic for you. Okay, used for practice and testing because they behave similarly to the real market but are valuable at all time. They are popular for backtesting and training. All right. Anyway, the both the real market and this everybody all of them are popular for backtesting and training. You want to do backtesting and training, the place you should go to is your demo. Okay, so the demo gives you access to practice before going into the real market with your funds. Okay, so what are the pros and cons? Okay, number one, available, always available, always available, always available. Then fairly consistent patterns. If you understand the market structure, all right, you understand the market structure, you understand your technical analysis very well, you will do well in this area. Now, news, whether macro, calendar news, nothing influence the price, okay? So like those ones we see unnecessary spike, out of maybe speech of Donald Trump, or maybe there was a news that spiked the market. In this case, there is no such. So what are the cons? It's not regulated like the real market. So this, what do you call it? The synthetic itself is not regulated. Why? Because it's proprietary, but the broker is regulated. But this aspect is the one that is not regulated. So in a nutshell, there is no way you can compare the movement of Vol 40 with any other market because there is no such market for you to compare it with. Okay, so whatever you see is what you take. Can be very highly volatile. Okay, so these guys are really volatile. So you need to understand your account size and the type of asset you want to trade because these guys are volatile. For those of us who have been in my community, one of the reasons why when I give a trade signal and I will tell you that the stop loss is $25, the stop loss is this, the stop loss is that, is for you to know if that particular trade, your account can carry it. All right? So they are very volatile and little movement can sweep your account. All right, so the next will be trading session. The next would be trading session. Now, in the Forex market, they are trading session. Now, why session? Now, we have this session because we have different regions, okay? We have different regions with different time zones. Different region with different time zones. Now, at this time, all right, we're about going to sleep now. That is when some people are waking up. And meanwhile, we are in the night, we're about going to sleep. So there's no way our markets can be open the same time their market will be open, or vice versa. So that's why we have this trading session, and they are all regulated by one body. And the sessions, they are the ones that overlap. They are the ones that closes before others starts rather. And this is just how they are. So we have the four different sessions. We have the Sydney session. Okay, so the Sydney session is where you have the AU, the Australian, all right, and the New Zealand. Okay, that's the Sydney session. So the market opened 5 p.m. EST. Okay, now EST is Instant Standard Time. Now, Instant Standard Time is New York time. Okay, so presently, the difference between New York and West Central African time, which is our own time, is 5 hours. Okay, 5 hours is the difference. So you just use that to do your arithmetic. What would 5 p.m. be? Okay, from Nigeria time. So that would be 1 p.m. Okay. So 1 p.m. Okay, not a.m. 5 p.m. Eastern time, Eastern Standard Time. Okay, we'll do this will be an assignment. We'll just, so please, I will snap it and we'll give it to you as an assignment. This will be one of the assignments. You'll do your arithmetic and tell me what this time is an assignment. So please, you can begin to take note of it. Now, how many persons do we have here now? 16. Okay, so the number has grown from how we started. All right. Okay, so we have the next one, which is Tokyo. Now, the Tokyo is where the Japan plays. Okay, that's where you have the Japanese yen. Open 7 p.m. EST to 4 a.m. EST. All right, now these two sessions, we call them the Asian session. Okay, we call them the Asian session. All right, the two together are called the Asian session, and they are our own nights. Is when we are sleeping, that's when their market will be running. Okay, so they play in the night while we sleep in this part of the world. Then we have the London which opened 3 a.m. EST. 3 a.m. EST, that's our 8 a.m. Nigeria time, okay? And closes 12 p.m. EST. So where we fall, we are under the London session. All right. Then we also have the New York section, which opened 8 a.m. EST to 5 p.m. EST. Now, this session, they are the ones that overlap. What does overlapping mean? Overlapping means that one will open while the other one is still running. Okay, but the one that opened first will close first while the other one will still have some time to run before it closes. Okay, so we have the Tokyo Sydney overlapping each other at exactly 7 p.m. to 2 a.m. EST. So these two markets run concurrently at this time, but they are 2 hours apart. They are 2 hours apart. All right, so we have the London, New York. Okay, so the London, New York also overlaps. All right, the London, New York also overlaps. High liquidity is the best time to trade. So this is just telling you how to approach the market. Then liquidity is the amount of participants in the market. So when you hear liquidity, all right, liquidity is not just the amount of participants. Yes, the amount of participants, yes, and the volume, all right, that is injected into the market. That is what liquidity is. So when there is liquidity, the market moves, and that's the best time to trade. But when there is no liquidity, that's when you see the market tend to consolidate. Now, these words, you may not really appreciate them now, but over time, you begin to appreciate them as you proceed as in an advance in your journey, okay? So liquidity is the amount of participants / volume in the market. Then spreads. Spread is the difference between the two currency, either buying or selling. All right. Volume is the size of trade activities in a certain pair. Then volatility is when market condition changes rapidly, high or low volatility. You see big moves, all right, and small candles. Okay, so the Sydney's start trading day in the forex market, smallest. Okay, so this is the same thing I've explained before. So Sydney says start the trading day. So when the market open on Sunday, the first market that open is the Sydney session. All right. Then the second that will open will be the Tokyo. So the Sydney is the smallest and calmest of the markets, okay? The smallest and calmest of the mega markets where the AUD and the NZD pair plays, which is the Australian market. Then the second one is the Tokyo session, which is the third largest forex market. Now that's where JPYs play. Low liquidity and volume, high spread. These guys, they are good with high spread. Then we have the London session, which is the third session. All right. What is traded primarily is the GBP, the Euro, and the Swiss franc, which is the CHF. And this is the center of trading. All right. Now, even the people of New York session, like those in the US, they love trading the New York, the London session. Most of them will wake up, to make sure that they cash the move of the market running into the New York session. Because one thing I've come to realize is that what happened in the New York session is defined during the London session. It's defined. The move will always show itself that this is what is about to happen, but the major move will not happen in New York session. Okay? So 34% of the forex markets, okay, that's the New York session, the London session now. 34% of the forex market, most active trading session, high liquidity, high volume, low spread, major news for the week. Then the final one is the New York session, marks the end of the forex day. 85% trades involve the USD. Big moves take place during New York session, major news releases, and the market is the USD and the Canadian dollar pair. Then volatility dies after 12 p.m. EST. Okay, so when the market has gone into ninth, like where we are now, all right, gradually by 10, volatility will die down even as the Sydney session is opening. It will be a very slow market. You see movement with short candles, consolidation, and all of that. So best time to trade, major overlap, that like the London, New York overlap, most liquid, okay, between 8 a.m. EST and 12 p.m. EST. That's 1 p.m. Nigeria time to 5 p.m., 1 to 5 p.m. Nigeria time. Then the London, Tokyo. London, Tokyo is 3 p.m. EST to 4 a.m. EST, which is 8 a.m. to 9 a.m. Nigeria time. What's the worst time to trade? Worst time to trade is during the New York session after 1 p.m. EST, when overlap stops. During the start of Sydney session through the beginning of Tokyo, non-overlap period, major holidays, e.g. like the US major holidays or the Europe. That's the time to review, reflect, and spend time with your family instead of remaining in the market. But for those of us who are in the synthetic market, we don't waste time looking at all of those areas. Okay, so Forex market time converter, these are just sites and applications for you to convert time so that you know the exact time in your own local country and time with the EST. So buy, sell, buy when currency is to rise, sell when currency is going down, strong up and down trend can cause market to be stuck in overbought or oversold for an extended period of time. Note, don't fight the trend, follow it. Now, there's this saying that say the trend is your friend, okay? In the Forex market, if you understand what the trend is and you know how to follow the trend, you will do excellently well in the Forex market. So this takes us to the end of trading session. Okay. So next now will be spread. Spread. What are spreads? Okay. Now yesterday I actually explained spreads. Okay, but I need to re-echo it again. Now the difference in buying and selling of the currencies is what we call spread. Okay, so you took your $1,000 to Aboki to sell. Aboki is buying it from you at 1,350. The same dollar you just sold at 1,350. You want to buy it. Aboki is telling you that it's 1,400. And that is the price because you are buying. You have sold, now you want to buy. So the difference between the buying and the selling is what we call the spread. Okay? And that is how the broker make their money. And that is how the Aboki too, who does the Bureau de Change, that's how they make their money. It's called the spread. So spread refers to the difference between the bid price, which is the highest price the buyer is willing to pay for an asset, and the ask price, which is the lowest price the seller is willing to accept. Here's the breakdown. Bid price, what buyers are offering. Ask price, what sellers want. Spread is equals to ask minus bid. So that's how you get your spread. Now, why does it matter? Why does this matter to you as a trader? Okay? Tight spread, when spread are tight, so when you are not paying too much for spread, which is small difference, more liquid market, lower transaction costs, major currency pair like Euro, USD, all right, and the rest. Okay, so now what this means is that you are paying a low cost. You are not paying too much. Okay, that's when the spread is tight. You are not paying too much. But when the spread is wide, the difference is big. So for you to enter a trade, which means you can be paying up to 30 pips. You know what 30 pips difference is. Meanwhile, in the same market, you can also pay maybe less than 1 pip or 2 pips on a particular trade. Then there's one that you are paying 30 pips. Now, what that means is that you need to struggle out to come out of that 30 pips before you can be in profit. Because when you enter the trade, the market will first push you down because you have paid down. So you first of all try to make the spread first before you come into profit. Okay, so if the spread is too large, you remain in negative for a very long time before you manage to now swim out of negative into positive, as the case may be. Okay, so widespread, large difference, less liquid market, higher transaction cost, e.g. small caps, stocks, exotic currencies. Factors that affect the spread: liquidity, that's more trading volume equals tighter spread. Then volatility, during high volatility, spread can be widened. Market hours, spreads are often wider outside the peak trading hours. Instrument type, forex, stock, commodity, all of them have spread range. Okay, so the next one will be trading windows. Sorry, this one, the characters are small, but you can zoom your screen. All right, you can zoom your screen to be able to catch them very well. All right, you can zoom your screen. The another thing you can also do is to put your phone on a landscape so that you'll be seeing this thing bigger than when you put it on on what do you call? Okay, so when you put it on landscape, you see your screen much better. Then you can also zoom to see bigger characters. All right, so trading window rather. In MT5, the trading window refers to the session where you can execute and manage trade. It's also commonly called the order window or new order window. Okay? Here is what you typically see in the MT5 trading window. So the first of them is the symbol. So the financial instrument, e.g. Euro USD, stock, gold that you want to trade. Then the volume is the lot size or position size you wish to trade. Then type. Now, type refers to the execution. Okay, so we have market execution, which refers to instant order, all right, as in buying at the current market price. Now, we also have pending orders. Now, pending orders are set to trigger a specific price. So for pending orders, we have the buy limit, we have sell limit, sell stop, buy stop, okay? Then we have stop loss and take profits. Okay, these are preset level to automatically close your trade at a certain price, all right, whether you are in loss or in profit. Then comment is optional. I don't know anybody who really used that comment, but what the comment does is to send a message to the broker, okay? Then deviation defines how much slippage you are willing to accept in points for market orders. So we have the buy and sell button, which is for you to execute immediately according to the selected parameter. So these are actually buttons, what you will see on your MT5 application screen. All right, so I have image in the next page. So you can zoom this screen. Now, for those of us who have been trading, we know what an MT5 is. I requested that you should download MT5 yesterday if you were not having it. Now, this is your trading window. This is your trading window. Your trading window is actually where you execute your trade, and this is where they run. So you have your balance, equity, margin, free margin, margin level percentage. And you see these trades that are running, these ones are positions that are open. So these are running trades, okay? These are running trades. These are positions that are open for this particular trade. Now, this is where the journey becomes sweet, okay? Because this is where the real thing we are actually learning now. This is where you begin to use your fingers to play with them, and you begin to know whether you are making money or you are losing money, okay? So let's now go to look at each of them, each of these 10: balance, equity, margin, free margin. Now they all have their different meanings and what they stand for. Okay, so let's actually look at them critically. Are you seeing the screen? You can see the balance, right? You can see equity. You can see margin. You can see free margin. So before we go to the explanation of whatever it is the other way, let me just explain it here first. Now, the balance is actually the amount you have left, your amount before you started your new trade. Okay, so let's assume you were not having any trade running. Your balance, your equity, and your margin, your free margin, will be the same thing. Your balance, your equity, your free margin will be the same thing. What it means is that if you have 1,409.35 as balance, that is what will be available across your equity and your free margin. All right, but because they are running trades right now, because you have running trades, that is why the prices, as in the amount in each of these levels, are different. So what is equity? Equity is your balance plus or minus your floating, your balance plus or minus your floating loss or floating profit. Okay. Now, what we mean by floating loss and floating profit is that it's floating because not until it is closed, it is not your own. So you can see this $66.85. Now that is profit because it's in blue. When it's in red, it's in loss. Okay. When it's okay, like this trade you are seeing here now, you can see that two are in red. Okay, two are in red here. What it means is that these two that are in red are in a loss. The other one in blue are in profit. So both the profit and loss, all of them gave a total profit of $66.85. So now the equity you are seeing here now is a total of the balance and the floating profit and loss. Okay, now what is the margin? The margin is the amount, all right, you paid down to be able to take this trade. Each of these assets have the margin you put down before you can enter the trade. If your balance is not up to the required margin, you cannot take that trade. If your balance is not up to the required margin, you cannot take that trade. So let's assume a particular asset margin is $5 and you are having $4.99. You won't be able to execute that trade because you don't have enough money. All right, you don't have the one to pay down. How much more the one that will run the trade? So that is what margin is. So margin is the amount you pay down before you can take a trade. Then we have free margin. All right, free margin. Okay, so your free margin is your equity minus margin is your free margin. Okay, your equity minus the current margin. So the money you paid down already minus your equity is what is free margin. So that free margin is the amount you still have left to take more trades. Now, what is margin level percentage? Margin level percentage is actually the equity you still have times the leverage, all right, that divided by the leverage rather that the broker is offering you. So it's a percentage, all right. So now this margin level percentage is up to 16,000 something. So which means this account still has a lot of leverage to take trades. This account can take much more trades right now. This is a $1,400 and something account, and this is a live account. It's not a demo account, okay? So it can still take more trades. Now, one thing about the margin level percentage is that you need to watch it. If your margin level percentage has fallen below 200, then your account is in trouble. Your account is in trouble. Now, when your margin level percentage fall below 100, gradually the broker will begin to start sending you a message. It will start telling you that to send emails to tell you that your margin has dropped. Okay, so that messages they are sending you, we call it margin call. So the message is to notify you that your account is in trouble. Please fund your account. So the message will always be that you should add money to your account so that you can continue with the trades. That's what broker will always tell you. Add money to your account, not you should close the trades. So you go and borrow money and add to the account, or you lose it at the end of the day. Okay, so now I have explained everything that is going to be in the next page, but let's go and look at them now. Okay, so we have leverage, margin, free margin, margin call. I've explained all of them. In Forex trading, margin refers to the amount of money a trader needs to deposit to open and maintain a leverage position. It acts as a good faith deposit or collateral. It is what I just explained. Here is the simple breakdown: leverage and margin. Forex is often traded on margin, which means you can control a large portion with a relatively small amount of capital. For example, with 1:100 leverage, it means you can control $100,000 position with just $1,000 of your own money. That's 1:100, okay? So that is leverage. Every broker gives you a leverage because your money is not enough to go into the market. So the leverage that the broker gives to you makes your money looks bigger than what you have, okay? So when it's 1:1,000, what it means is that your $1 is 1,000. So you calculate that $1 okay, which is 1,000 times. If your money is $100, that is 1,000 times $100. You know what that means, okay? So that would be 100,000. That's what you can control with 1:1, 1,000 leverage. So types of margin, we have the initial margin, which is the minimum amount required to open a trade. Then maintenance margin, this is the minimum amount needed to keep a position open. If your balance fall below this level, you could face margin call. So that is the margin level percentage, okay? Margin level percentage is the same thing as a maintenance margin. Okay, so we have free margin. Free margin is the amount available in your account to open new position or withstand drawdown. Margin call. If your trade goes against you and your equity drops below the maintenance margin level, your broker might issue you a margin call requiring you to deposit more funds or close position. So this is exactly everything I just explained. Okay, margin required, trade size, leverage, for example, trading one lot. Okay, so these are just arithmetic. This is what I have explained about leverage and 1:100 units and all of that is the same thing here. Okay, so the next thing now, which is going to be the last, is candlestick anatomy. It's not actually analysis, it's anatomy. Okay, it's anatomy. Anatomy is just study of something, okay? It's not the analysis yet, but you want to understand and know how the candle looks like, okay? And how the body you want to, that's the anatomy. So it's not analysis, I'll correct it. So this is number one, how to read candlestick, how to trade using candlestick. The Japanese candlestick is made up of a fat region called the body and a thin line either above or below called the wick or shadow or exhaustion. Now, the OHLC tells you all that is needed to know about candlestick at a particular time frame. Now, O stands for open. So every candle has the history of OLC. So O stands for open, all right? O stands for open, H stands for high, low stands for low, L stands for low, and C stands for close. That's the OHLC. Okay? So let me break it down for you. Now, the O is the open. So every candle has an opening price, all right, where it opens, okay? It has an opening price. Every candle opens and closes, and there's a level it goes up to, that is the high, and there's a level it goes low to, that is the low. But the body is what will tell you of the open and close. We'll be going into the chart and I will show you what a candle anatomy look like, talking about the full body, the wick, which is the shadow, or you call it exhaustion, all right, and the open, close, high and low. Okay, so open stands for where the price value of the market is when it opened using a particular time frame. Now, each candle you see represents a time frame. So now we have 1 minute time frame, we have 2 minutes, we have 3 minutes, we have 1 hour, we have 30 minutes, we have 15 minutes. Every time frame, all right, a candle represents that time. So when you are in 4 hours, what it means is that it takes 4 hours for one candle to form. It takes 4 hours for one candle to form in 4 hours time frame. The same thing in daily. It takes the whole day, 24 hours, for one candle to form on the daily. It takes 1 minute for a minute candle to form. So the candles, they all look alike. They are the same thing, the same body, wick, but it's the time frame that determines where you are dealing with. Okay? So we have the high, which is the highest point that the price reached. What this simply means tells us that at some point the body of the candlestick actually got to that height before it was pushed downward or rejected. Then we have the low. The low is the farthest depth the candle or price ever reached before it was rejected. Then close. The close is the price at which the market, that particular candlestick, ended at that time frame. The price at which a particular candlestick closed will be the opening price for another candle. It's becoming big English, right? When we come to candle, it's usually, it will look as if the thing is beginning to get tough. Okay, just keep your questions, all right? Keep your questions, we'll respond to them. Okay, so now let me now go to, let me go to the chart. Let me go to the chart and show you what candlestick anatomy look like. Okay, so this is a candlestick. Good. This guy has gotten to my level. That's good, but I has not kissed it. So this is actually advanced. Okay. Now I think those of us who came in early, I was actually here trying to mark this chart. All right. I was trying to mark this chart because there's something I'm looking for on this guy. So I'm actually marking the chart for that thing to happen. I was waiting for this market to come to this region. All right. I was waiting for the market to come to this region and probably take out this high. So it has swept liquidity, it has swept all of this liquidity, but the market may decide to return from here because this was the previous uh, um, bullish candle before this market went down, and we have what we call fair value gap. This is English, you don't need them now, all right, but when you get to that bridge you begin to cross them, all right. It's one step at a time. Okay, so that's why I came here to wait for this guy, but I will now have to wait for something to happen here before I will take this trade for a sell, and we'll push it down. Okay, so now I came here to show us what a candlestick look like, where we have the open, close, and okay, so this is what a candlestick look like, and this time frame is 1 hour time frame. This time frame you are seeing here is 1 hour time frame. So what it means is that for every candle, blue or green, that you see here, it took 1 hour for each of this candle to form. It took 1 hour for each of this candle to form. So you see this particular candle, this is a Maribuzo. It does not have wick at the top. It does not have wick at the bottom. All right. Okay. But most candles you will see will have wick at the top and at the bottom. But this particular one does not have at the top nor at the, you hardly see this type. Okay. So what it means is that as soon as the market closes here, this guy opens and it drops. And as soon as the market closes here, it is open from this other one without any pullback first. So here, what it means is that buyers did not struggle on this candle when it started the move to the end. For that 1 hour, buyers did not make any move. It is in this next 1 hour that buyers now begin to, the market pushed down, buyers pushed it back up, and buyers took over by the new hour. Okay, so now let me now show you. Well, we'll be using this particular candle, this particular one. So I want to show you something. Okay. Okay. So these are the four architecture of this candle. Now, this level, this wick here, for this candle, this is the high of the candle. So this particular level, this is the high. Okay, so this is the high. Now this is the, sorry. Now this one, this is the close of the candle. Now, this is a bullish candle. Now, we have bullish and bearish. Bullish is when the market is buying, while bearish is when the market is selling. So, in this case here, the green is the buying candle, while the red is the sell. Now, whether it is green, whether it is red, whether it is blue, it does not really matter because the most popular though is this green and red. But there's a level you get or you begin to see different colors. People use different colors. Like me, I use different colors. A color does not matter. It's the direction that matters. The person who owns the chart know which color he's using for buy and which color he's using for sell. Okay? So coming now we have the open. So for this, in this case, the open is at the bottom. Open. Then this is the low. Okay, so now this is the full anatomy of a candlestick. Every candle has high, close, open, low. OHLC. Open, high, open, low, high, close. OHLC. Okay, every candle has it. When you begin to do analysis, you begin to see the use of this thing because you want to see some candle, which one is higher, which one is higher than the other. You'll be looking at certain things. You want to know the low. Maybe you are looking for the previous low. You want to know which one is the lowest. You must check the price at which that particular candle low touched to see which one is the lowest and which one is the highest. So please, one thing you need to note is that high is always at the top. Low is always at the bottom. Hello? Are we together? High is always at the top. Low is always at the bottom. But do you see this open and close? They interchange. How do they interchange? They interchange for both bearish and bullish. Now, what it means is that the bullish candle opens at the bottom. The bullish candles open at the bottom. So in this case, when this market closed, this new candle now opened here from this bottom. It first of all went down, all right? First of all went down, then pushed up back to the open price, and it pushed to this level, pushed high to this level, but could not sustain it. The sellers pushed it down to this level, and it closed here. Now, this next one, this is the open, all right, and it pushed up. Now, but in this case of this particular red candle, this is the close, while this is the open. Let me put it so that you can see the difference. Okay, let me push this one to this side because of the, okay. Let me also push this one to this side. Okay. So now, this is the open. The open is on top. Now this is the close. Okay? So this is the close, this is the open. So when the market is selling, it opens at the top and close at the bottom. But in the case of buy, it opens at the bottom and closes at the top. But whether buying or selling, the high remains high and the low remains low. I hope with this few points of mine, I've been able to convince you and not confuse you. God bless you. Congratulations. All right, so this by this we have come to the end of today's class. I'll be ending the recording now. We have done 1 hour, 2 minutes. I'll be ending the recording now so that we can go into questions and answer session. All right.